Something strange is happening in the silver market right now. And no, I don't mean price. I mean the metal itself, the physical metal. Because while everyone's staring at charts, something else is quietly accelerating in the background. Silver is leaving the system faster than it's coming in. And once you notice where it's going, you start to understand why this feels different from anything we've seen before. I didn't catch this from a headline. I caught it the same way you probably did. By noticing small things that didn't add up. Delivery delays that used to be rare. Industrial users suddenly locking in long-term supply. Mints acting nervous without saying why. That's usually the tell. When nobody's panicking out loud, but everyone is quietly preparing. Here's the uncomfortable part. This isn't being driven by investors. It's not stackers. It's not YouTube channels talking about silver shortages. It's industry. And industry doesn't speculate. Industry consumes. Think about that for a second. An investor can sell tomorrow. A factory can't. Once silver is built into a product, it's gone. Not stored, not vaulted, not waiting to come back to market. Gone. And that drain has accelerated. What most people don't realize is how thin the margin already was. For years, silver production barely kept up with demand. Not comfortably, barely. Any small disruption and the balance breaks. Now layer on what's happening today. Electric vehicles, solar panels, power grids, medical tech, defense systems, data centers. All of them need silver, not as a nice to have, as a critical input. And they don't care what the spot price says. They care whether the line stops if silver doesn't show up. That's the disconnect nobody on financial TV talks about. Price is a financial signal. Demand is physical reality, and physical reality is winning. Here's where it gets even more uncomfortable. A lot of this demand doesn't make headlines because it's boring. It's not a crisis story. It's not dramatic. It's just purchase orders, long-term contracts, quiet stockpiling. The most dangerous trends are the quiet ones. Silver is being consumed in tiny amounts per unit, spread across millions of units. Phones, cars, panels, sensors. No single product looks like a big deal, but together, it's a vacuum. And once silver enters these supply chains, it almost never comes back. Recycling sounds good on paper, but in reality, it's inefficient and expensive. A lot of that silver is effectively lost forever. Now compare that to paper silver, futures contracts, ETFs, unallocated accounts, claims on silver that assume availability, assume liquidity, assume delivery is possible if needed. That assumption only works when industrial demand is stable. It isn't anymore. This is where the system starts to strain. Paper silver pricing was built for a world where silver mostly sat around, a world where demand ebbed and flowed, but supply was predictable. That world is gone. What we're seeing now is silver being treated like oil during an energy shock. You don't price oil based on how much is in a spreadsheet. You price it based on whether it shows up at the refinery. And that's the shift most people haven't adjusted to yet. Mainstream commentary still talks about silver like it's a speculative asset, a cousin of gold, a trade. Industry doesn't see it that way. They see it as infrastructure. And infrastructure demand doesn't blink at volatility. It just keeps pulling. This is why reported inventories don't tell the full story. Because inventory doesn't mean available. It just means counted. A lot of silver that shows up in inventory numbers is already spoken for. Committed, earmarked, waiting for shipment. That's not surplus. That's backlog. And when industrial buyers sense even a small risk of disruption, they don't wait. They overorder. They extend contracts. They secure supply years in advance. That behavior alone can break a fragile system. Here's something that should really make you pause. Silver mining isn't ramping up fast enough to offset this. Not even close. Most silver is mined as a byproduct. Copper mines, lead mines, zinc mines. So even if silver demand doubles, supply doesn't magically respond. You don't just turn on more silver production. That lag matters. It means the drain can accelerate long before supply has any chance to catch up. This is why price suppression narratives exist at all. Not because someone controls everything forever, but because financial pricing mechanisms are slow to recognize physical stress. They're backward-looking. They assume yesterday's balance still applies today. Meanwhile, real-world demand is forward-looking. Factories plan years ahead. That tension can last longer than people expect, until it doesn't. History has shown this pattern before, not just with silver, with energy, with food, with shipping. Everything looks fine, until it isn't. Then the adjustment is violent. What's different now is how central silver has become to the modern economy. This isn't ornamental demand. This isn't jewelry-driven cycles. This is system-level dependency. Try building a green energy grid without silver. Try electrifying transportation without it. Try expanding data infrastructure without it. You can't. And yet, silver is still priced like a side character. That mismatch doesn't resolve gently. Now let me be very clear about something. This isn't about predicting a date, or calling a price, or promising anything. It's about understanding pressure. Pressure builds silently. And the silver market right now feels pressurized, not because investors are excited, but because industrial demand doesn't negotiate with financial narratives. If you're a manufacturer and silver doesn't show up, you don't care what the chart says, your production stops, your contracts break, your costs explode, so you secure supply at almost any price. That's the kind of demand that breaks paper assumptions. And this is why the mainstream ignores it, because it doesn't fit a clean story. It's slow, it's technical, it doesn't spike overnight, but it compounds. Every month that industrial demand quietly exceeds mine supply, the system gets tighter. Every year that silver is consumed faster than it's replaced, the buffer shrinks. Eventually something has to give. Either price reflects scarcity, or availability does. And availability failures are always more disruptive than price moves. The average person feels this long before they understand it. Higher costs, delayed products, unexplained shortages. By the time it's openly discussed, the drain is already advanced. That's why I pay attention to the quiet signals. Not headlines, behavior. And behavior right now says silver is being treated like a strategic material, not a trade. Once that mindset spreads, the system doesn't behave the same way again. You don't need to panic, you don't need to rush. But you do need to see what's happening. Because the silver drain isn't theoretical anymore, it's operational, it's industrial, and it's accelerating quietly without asking permission from the price. And once enough people realize that, the conversation around silver changes permanently.